In this week's video, we'll review the latest charts and data to help us better understand the case for a Magnificent 7 rally. We'll be moving quickly, so feel free to use the pause button on your video player. Your leaders of the April 2025 tariff flow, for the most part, were the Magnificent 7 stocks: Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla. Lower left-hand corner of your screen is where that rally started. So this A to B move that ended in October of last year has retraced 50%, which is not uncommon. Not uncommon to retrace 38.2%, 50%, or 61.8%. As you can see, price seems to be responding at the 50% level. We at least have a bounce. MAGS, which covers the Magnificent 7 stocks, it's an ETF. In isolation, it was up 2.37% for the full week. And during Friday's session, MAGS, the Magnificent 7, relative to the other 493 stocks, XMAG in the ETF world, the Magnificent 7 were outperforming during Friday's session by 1.65%. Also relevant, price is retracing above a green cloud, and the green cloud is getting thicker rather than narrower. So this represents an area in this region here of potential strong support. The upward sloping green cloud, also a good sign, with the caveat that it's rolling over on the back end. We don't want to make any assumptions, but the retracement, not particularly abnormal. This ratio got ahead of itself here. So the question is, are we going to resume the uptrend, or is this ratio going to break through the cloud in the coming weeks? Again, we're looking at the MAGS ETF. This is a DeMark chart. DeMark charts and indicators are proprietary tools from Market Studies, LLC. This 913 told us it was possible that this uptrend was starting to become exhausted, and that is what happened. These propulsion targets down here basically told us when we were here, it wouldn't be unreasonable to come back to this level here, and that's for the most part what we've done. During Friday's session, MAGS, the ETF, was trading at 62.54. These levels here, the red diamonds are the propulsion magnets, 59.3. Having said all of that, you can see the upside target has appeared. So this pairs with this, and this works well with this. The upside target, not a forecast, it's a potential target. It's something that could happen based on this and this move, is at 75.45. That's roughly a 20% gain from 62.54. Also noteworthy, the Supreme Court struck down President Trump's tariffs, at least in the form that he originally implemented them, some of the tariffs. And logic says if this was the tariff scare here, if some of the teeth has been taken out of the president's power relative to tariffs, it's possible that that event could spark a rally. This simply tells us to keep an open mind about a rally. And this simply tells us to keep an open mind about a rally, as does the green cloud. IWY, large cap growth, has heavy exposure to the Magnificent 7, and you can see, like MAGS, had a nice run here, relative to SPY, was a leader off of that tariff scare low here from April of 2025, and now it's retraced almost all of those gains. That's the bad news. The good news would be what once acted as resistance in 2020, what once acted as resistance in 2021, may now act as support in 2024, may now act as support in 2025. We're back to that level here, and all of this consolidation after the bullish breakout here is occurring above an upward sloping 200-week moving average. This is another chart that simply tells us to keep an open mind about the potential for this uptrend resuming. Our interpretation of this chart would shift if we move into this area here, and more so if we move to the other side of the 200-week moving average. The longer we stay below it, hypothetically, the more meaningful it will become. A short stay between an upward sloping moving average is typically bullish, and that's exactly what happened after the lows in 2022. This week, during the trading session on Friday, February 20th at 2:45 p.m. Eastern Time, IWY, the Russell Top 200 Growth ETF, was outperforming SPY by 0.44%. You can find this chart on our X feed at Shavaco Capital. This is the triple Qs, the NASDAQ 100 relative to large cap growth. In this case, SPYG is in George. Here are the ticker symbols. It's a monthly chart. Typically, when you've come back to the 30-month moving average and made a stand, that's been good for the market. This is the S&P 500. Also good for tech. This is the ratio of XLK relative to SPY. That would be the good news. The bad news would be, look at the slope of the moving average here, the 30-month moving average. Look at the slope here, and then look at the slope here in 2022, and now look at the slope in the present day. This chart is unquestionably more vulnerable here than it was here or here, so we have to keep that in mind. Having said that, if we can rally, get back to the other side, history says that could be a good sign. We'll learn something either way. We're not making a prediction here in any shape, form, or fashion. We're just trying to understand what to look for favorable outcomes and potentially unfavorable outcomes for certain segments of the market. If we look at the same ratio, but we go to a monthly cloud, a rising green cloud can act as support, as it did here. We held above the cloud here. We came back to the cloud, and it held. We're back to the cloud now. That would be the good news. The more concerning news relative to this right here is, see how the cloud is upward sloping here and we're above it? It's upward sloping here. This cloud is flattening out and very thin. So this tells you we're somewhat skating on much thinner ice here. So it's a lower probability that we're going to turn back up here relative to what we did back here. A lower probability, not a zero probability. It's a good sign thus far that blue is back above red relative to these spans on the cloud. And it's also a good sign that the cloud flipped momentarily from red, but now it's green. So this trend is trying to walk across the frozen pond, and it's doing so in a very tentative manner. It is possible that the trend is going to fall through the ice and come to this side. We'll see how it unfolds. Thus far, the ratio looks like it's trying to make a stand near the cloud. Another piece of concerning news, the fact that the lagging span, the green span, is below the ratio. See here? That tells you you've got a weaker trend too. So this is a weaker look here than all of this back here. See, when we came back here, span isn't as ugly here. Here you don't even cross below. So we'll learn something either way here. Thus far, so good. In terms of pure risk on, risk off, you can pause your video player here. The credit markets look tame relative to this concerning look in January of 2022, where the S&P 500 peaked on January 3rd, 2022 on a closing basis. Didn't bottom until October of that year. Now let's step back and take a look at the big picture. The S&P responded favorably to the Supreme Court's decision. It was up 47 points for the full session on Friday, February 20th. You can see there's nothing particularly concerning on this chart here. These levels are reference points, and they help us maintain realistic expectations about the possibility of double-digit pullbacks. For the rally off of the April 2025 low to be in doubt, we would have to drop below and for the most part stay below this upward sloping blue line. Relative to the close on Thursday, that would represent hypothetically a drop of 8%. And we all know that falls into the 100% normal and to be expected category. All of these levels represent reference points for us. helping us maintain flexibility and objectivity. From a leadership perspective, concerns about the Nasdaq's leadership relative to the S&P 500 and concerns about this rally here off of the Q4 2022 low. You may remember the Nasdaq bottomed roughly 3 trading days before the end of the year in calendar year 2022. As long as we stay above this cluster of AWOP lines here, it's pretty easy to make the case that this uptrend is still intact. We haven't done anything except make a higher high recently, haven't made a significant lower low. We'd really have to undercut that April low from last year, and that's above these lines. We have good reference points allowing us to be patient. It's logical to anchor your AWOP lines to turning points. The blue line anchored to this peak here in 2021. The red line down here to the bottom in 2022. We're back down to that line. So this basically says this rally here in Bitcoin off of the 2022 low is still intact. If we stay above this line and this line, it looks like a normal retracement within the context of an uptrend. What once acted as resistance, may now act as support. That's true of the red line, came down and tagged it, and also potentially true of the blue line. Nothing particularly alarming here on the broad 1500 composite S&P chart. Hypothetically, from Thursday's close, if we backtrack to this level, it's about 8% below where we were trading. The close on Thursday, 100% normal and to be expected. Always good to keep this concept here in mind. We recently covered this chart and talked about the upward sloping 200-day moving average. We've also got this cluster here of anchored volume weighted average price lines. Volume is in the equation when we're looking at a chart in isolation, as we are here. XLK, the tech sector for the S&P 500. Is this a vulnerable chart? It is. Are we above these anchored volume weighted average price lines? We are. Are we above an upward sloping 200-day? We are, allowing us to try to be patient while respecting the vulnerability of this look here from a price and momentum perspective. Also looking at XLK in isolation. Down here, this is the bottom in Q4 of 2022. The A to B move in this case would be from here up to here. If we retraced 38.2%, that would bring us down to this region in here. If we retraced 50% of that move, it would bring us down into this region here. If I slide this chart over a little bit, you can see if we went down to this level here from where we are today, that would be pretty significant. It's about a 19% drop. That would be the bad news. The good news would be we've got a potential area or reference point here, and that's less than 7% below where we were trading on Thursday. Also noteworthy, if we retrace the move off of the April low here, this is the low here, see it coincides with this. The peak up here, this would be your A move down here, right down here. This is our B move here. 38.2% level comes right in near these lines here, which is about 7% below where we were trading on Thursday. The 50% retracement comes in right in this level here where we have two great reference points. This gap, what once acted as resistance, and here what once acted as resistance, may now act as support. That represents a drop of approximately 15%. That sounds painful, but if we want to make money, how many of you at home, raise your hands, how many people want to make money? That's what I thought. If we want to make money, we have to understand that volatility is 100% normal and to be expected. A lot of volatility here, and as long as the trend holds, by definition, any pullback will go on and make a higher high. That's the definition of an uptrend. It makes a series of of higher highs and higher lows. That's the textbook definition. We all know the world isn't as clean as a textbook. Similar concepts here. Now you're looking at SPY, G as in George, in isolation. The rally off of the April 2025 low, still intact. You can pause your video player and read this and this. We don't want to fight reality. Reality says easier markets are often followed by harder markets. Harder markets are often followed by easier markets. If we want to make money and let our capital compound, and we want to avoid overtrading our account, we have to learn how to deal with volatility. As we've discussed in the past, foreign stocks, cyclicals, metals, they all look good. What would we need to see evidence, observable evidence that we can see, measure, and put in a model to take another incremental step in this direction? We've got a longer term version of our stack rank that we pull out from time to time, and we pulled it out this week. It takes a very long term perspective. Traditionally, we would look in this window here between 1 month out to 12 months. But when long term trends are potentially flipping, it makes sense to look out even further. 18 months, 36 months, 48 months, 60 months. And to understand that, it's helpful to look back 18 months, 36 months, 48 months, and 60 months. Why? Because it helps us understand trends on multiple time frames. The moral of the story here is metals, semis, foreign, cyclicals have all proven themselves. We have to be open to increasing our exposure to them incrementally if they can continue to clear hurdles. So the question going forward, tech, growth, and the S&P, are they going to move back up this list a little bit, or are they going to stay down here? One of the first takeaways on this chart, EFV relative to SPY, is everything that's transpired from this gap down here is somewhat in question now. Why do I say that? Because we've cleared levels back here, if we put the AWAP lines on here, that we weren't able to clear in the past. And the fact that these lines are tied all the way back to 2018 tells us something. It means, on a relative basis, EFV, foreign value, has made some significant progress, measurable progress, relative to the S&P 500. Having said that, this is a key level here because this gap down in this region here is where the underperformance really kicked off, in this region here. So anything up in this region here remains important. This is the highest high right here. This is the lowest low. You can see they come in, acts as resistance, and we fall. So it's prudent just to see what happens here. It gets a lot easier to add to your foreign exposure if we can get out here. It would also get easier if we can clear this area in here that acted as resistance in 2023 and acted as resistance again in 2021. Unlike many relative charts, this chart has cleared that tariff high here. So this is a relevant higher high here. Having said that, this is also a relevant higher high. So ultimately, if you read this, we'll see how it unfolds. Similar situation here. See the blue AWAP line tied to this peak here? See how price respected it here? So we still need to clear that level there. And you can also see this purple AWAP line here acted as resistance in this region. If we come down on that purple line, we're still below that purple line as well. So very similar thoughts here. There's lots of gaps in here that could act as potential resistance, including this massive gap in this region here. If you want to say something positive about FNDE relative to SPY, if we drag this chart over a little bit, See how these lines are starting to flatten out over here? That's indicative of a waning trend. So we have consolidation here. These lines start to turn up instead of trend down. That would be a good sign. Same concepts apply here. This is FNDF, something that's done a lot. FNDF has proven a lot from this low here in 2025. There's a lot of hard data backing up the foreign exposure case. And this is relevant too. Technical analysis is about subtle shifts in human behavior. See the purple line in here? There's a pink line below it and the black line. See the pink and black line here act as resistance in 2019. They also act as resistance in 2023. Not the case in the present day. That's significant. It basically tells you everything that market participants were concerned about in here may be starting to shift in a positive manner in the direction of FNDF relative to SPY. Having said that, horizontal resistance here, horizontal resistance, this acted as resistance right here, we're back to those levels, and we still have some AWOP lines to contend with. However, the further back we have to go, the less relevant they become. Why? Because the things that investors were concerned about back here in 2018, they could have changed significantly in the present day. So the further back we go, the less relevant these lines become. Hence, why it's relevant in a bullish manner for foreign stocks that we took out these two lines that were relevant in 2023 and relevant in 2019. So this tells us we should be open to adding to our foreign exposure. But we don't want to jump the gun. Things look pretty good here and it didn't work out well. They look better here and it didn't work out well. So we'll just see how it unfolds. If you know your stock market history, you know the secular bull market started after a low in the second half of 1982. So see the pink and the purple lines here, the AWOP lines of gold relative to the S&P 500. If we follow those lines down, we came up and tagged those lines recently, and we're still below those lines. They also acted as resistance in October of 1987. That's the start of the bottoming process for the S&P 500. The S&P really didn't make its final low until I believe December of 1987, early in December of 1987, at least on a closing basis. Intraday, I think it was probably made in October. A lot of great things have happened for gold, but we can be patient to see if we can clear a line that was relevant at a very, very important time window, October of 1987, and also relevant as the secular bull market was starting. At some point, too, if gold continues to rally, we're going to have to contend with this orange line that acted as resistance in 2011. Having said all of that, you want to hear some good news? The good news is this purple line goes all the way back to 2011. That's a long time ago. See, we couldn't clear it here. We couldn't clear it here in 2020. We've been above it now for what looks like several months. So that's a really good incremental step. Here's another good incremental step. This is tied to a low back here. This is tied to a high. So when these lines come together, it's telling you, just like resistance is, that this is a really important area. We've been consolidating since 2015, almost a decade. It looks like gold's breaking out to the upside. The longer we go sideways, the bigger the move we can expect to get. So we'll see how it unfolds, but like foreign stocks, we really have to be open to adding to our metals exposure. But there's no rush. If really, really good things are going to happen for years, gold's going to kill the S&P 500, then we know with 100% certainty eventually this level will be cleared. And that's something that may happen very, very soon, maybe as early as next month. It just hasn't happened yet. If we look at foreign stocks, this is the S&P World ex-USA SPDW relative to XLK, the tech sector. You can see on this monthly chart here, We have not yet cleared that tariff scare high from 2025, but we're getting very, very close to doing it. Having said that, we do have areas that mattered. All of this acted as resistance in here in 2019, resistance here in 2017, resistance here in 2020, resistance here in 2021, again in 2022, maybe even into early 2023 here. So this chart still hasn't cleared any of those downward sloping levels, at least yet. So at a minimum, let's just talk anecdotally. If we were going to sell XLK and buy SPDW, something we don't own, probably at least want to see it clear this level here. And at a minimum, it's got to clear these levels here, something it hasn't done yet. No assumptions. We'll see how it unfolds. And one of the reasons why we're looking at EFV is one of the stronger ETFs, foreign ETFs. Same can be said for FNDF. That's why we're looking at them. Pretty much everything that we've said earlier in this video applies to this chart. This is EFV, foreign value, relative to XLK, and we have not exceeded that tariff high yet, and we have several areas of potential resistance. How do you choose these lines? You choose the lines that the market cared about. The market cared about it here, resistance, cared about it here, resistance, cared about it here, resistance, 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 resistance. So if the market cared about all those levels in the past, we're going to assume that it cares about them until proven otherwise. When we looked at SPDW relative to XLK before, that was a monthly chart. This is a daily chart, and you can see this is a discernible lower high relative to this high here. This chart is SPDW relative to XLK. The market respected the orange line, we're still below it. The market respected the purple line, we're still below it. The market respected the gray line, we're still below it. The market respected the red line, we're still below it. The market respected the purple line here and here, we're still below it. The market respected this pink line, again, here and here, we're still below it. So again, if we know with 100% certainty, if foreign stocks are going to smoke tech for the next decade, we know with 100% certainty, repeating, that we are going to clear this level here. Thus, we can be patient to see how it unfolds. We have some exposure to foreign stocks. We have exposure to XLK. Both look good in isolation. Neither look alarming in isolation. Tech is more vulnerable, but not alarming. We're in a bull market, so we're going to stay patient and err on the side of trading less rather than more. How long will we stay patient? Market will make that call. Now let's talk about the reasons to believe that SPDW will outperform XLK. This is a weekly chart. Notice the white space between the downward sloping 200-week moving average in here. That's a weak trend. Well, look how close we came to it here. We touched it and actually exceeded it a little bit here, and we're back to it again. What does that mean? It means this downtrend, the momentum is waning, which means we have a higher probability of this turning up. Never touched the red line in here, weak trend. Got closer, touched it, we're back again. This is still red, but it's thinning out, and we're above the cloud. Momentum, no question, it's been dissipating. So price, the ratio has been falling, momentum's been dissipating. We just have to keep an open mind about a trend reversal here. Still, we'd like to see a higher high above that high here, and we'd like to see this weekly cloud flip to green. We'd also like to see the lagging span in all three spans and the ratio to get to the other side of the cloud and to get to the other side of the 200-week moving average. This tells us we should keep an open mind about that happening. This is a weekly chart. This is a monthly chart, SPDW relative to XLK, and we are below a downward sloping cloud. How many bullish boxes of the 5 boxes are we checking, SPDW relative to XLK? The answer is 2. What are they? Price is above red, and the lagging span is above price. The rest are no. Is blue above red? No. Is price above the cloud? No. Has the cloud flipped from red to green? Not even close. We could also add, is the cloud flat, upward sloping, or downward sloping? It's downward sloping. That's another strike. Momentum, this looks different here. You don't really see much of that going back here. Look how high RSI is on the monthly chart. Also telling us to keep an open mind about the case where we get out here. We've already said the data that we have in hand is favorable for foreign. So we are more than open to increasing our allocation if additional hurdles are cleared. In terms of over trading as well, if you look at this stack rank that goes out and includes weightings for 18 months, 36 months, 48 months, and 60 months, growth, tech, cyclicals, foreign, semis, and metals are all scoring better than SPY that's down here. SPYG growth above BGT, FTech, XLK, IYW, SP High Beta, foreign, value. See, these are the 2 that we covered in the video numerous times. We covered this numerous times in the video. We did that for a reason. Emerging markets also showing some nice strength. We know what to look for. And thus, it's extremely important that we don't make any assumptions about any topic on any time frame. Leadership, risk on versus risk off, you name it, don't assume. It's incredibly important that we remain open to a wide range of outcomes, from wildly bullish to wildly bearish. We should learn to embrace rather than fight change. In the markets, in the context of a bull market, we are now in a position where we're at a fine line between sitting tight and avoiding overtrading and making additional moves, because there are clearly better places to be potentially from an opportunity cost perspective. That's evidence-based. Having said all of that, it's proven and documented time and time again, overtrading will kill you. Thus, in a bull market, when in doubt, we're going to leave it alone. Always have to keep in mind that all human beings bring bias to the equation. That includes yours truly. So we have to be agnostic about all of this. We're not rooting for tech or growth or the S&P 500. The goal is to try to help all of us make money, and to do so in a prudent manner within the context of what the market is willing to give. And we all know the only way that we can do that effectively is that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.